Thank you, Raleigh, and thank you everybody for your patience. I'm sorry I'm a little delayed here. I'm dealing with the excitement of travel delays in New York airports, but I'm here. So what I want to do today, I want to share a little bit about how I see the markets, and I will explain why I have developed this way to look at the markets. I started, I appreciate the introduction Raleigh gave me, but that doesn't really give you the full perspective of how I started, which is I had no clue. I started with a very small retail account and a few $1,000 account, and I was paying full service commissions. I don't even know if those exist for small futures accounts. And I went through the process of pretty efficiently blowing several accounts out in a very short period of time. And eventually, I developed a style of trading and a way of looking at markets that works for me and seems to resonate with other people. So I want to share that with you today. And here's, if you look at your screen, here's kind of the brief outline of what we're going to do. This is about quantitative discretionary trading, which to some extent seems like mixing oil and water. So why both quant and discretionary? I'm going to talk a little bit about the nature of the market, how I think the market works, what drives the market, and that will lead naturally into how we find an edge, how we analyze the market, how we understand the market's movements. I'm going to share with you a very simple model I've developed that would suppose that market action is driven by two forces. And it's the interaction of these forces that makes the patterns that we see. And there's a lot we can do from that. And then we'll talk about how to apply that, where to go from there. And I'm also going to share a little bit about my firm, Waverly Advisors, and how we might be able to help you in your trading journey. So my early explorations with markets were kind of driven by this question, how do markets really move? And I've told the story elsewhere, but I was talking to a broker friend of mine and going through some of the struggles I was having. And he said, well, Adam, I think the problem is the way you're trading, markets don't really move like that. And I said, that's a really good point. How do markets really move? And his answer was, I don't know. And that launched me on more than a decade of research and exploration to try to understand how markets really move. So we can take that question down another level and ask, are there non-random repeatable patterns in markets? And we're not going to get too deeply, we're going to talk a little bit about randomness, but we're not going to get too deeply into the debates over efficient markets. Are markets efficient? Do markets move randomly? But we need to understand enough about randomness to understand why randomness is bad and why we need to overcome that. And another question that I kept asking was, is it really possible to make money trading? And I had the experience as I was learning to trade of tracking down various gurus, various people who claimed to have knowledge and discovering that they didn't. And discovering that a lot of people lie about their results, basically. And even the people who are successful, perhaps their results are simply random. Perhaps they're explainable by random chance. And is that true? And I can tell you pretty conclusively the answer to that is that yes, it's possible to make pretty good money trading, but it doesn't work quite in the way people think. And so here, still kind of by way of background, here is what I have come to learn and come to understand about markets. They say that you don't really trade the market, you trade your understanding of markets, you trade your belief about markets. Now, my understanding has come through the School of Hard Knocks and deep research. May be true, may not be true, but here's what I believe. Markets are almost always, but not quite always efficient. So by efficient, we mean efficient in the academic sense, and this means that basically everything that is known that can be known about a market is priced into the market. The market is priced fairly. And if this were true, then it would not be possible for us to make money trading. So that's why there's so much emphasis on looking for inefficiencies in markets. And those do exist. Those are potential opportunities for profit. Inefficiencies also seem to come in spurts or clusters. You will find that markets are usually efficient, and when they're not, they may be not efficient several times in a row, which can lead to some pretty good trading opportunities. Price movements are usually random, and this separates me from a lot of the technical analysis crowd that will analyze the tiny details of every bar and say every tick means something. I'd say that's garbage. There's so much randomness in the market. There's so many competing influences, so many people trading for so many different reasons. To assume that every tick of every bar means something is incredibly naive. And you can only do that if you don't really understand how the market works, basically. So most of what we see is garbage, just random garbage. We can't do anything with it. And we'll see patterns in that randomness sometimes. Sometimes they'll mislead us, and that really can't be avoided. Behavioral factors strongly influence price movements at times. And, we think in many ways analytically, scientifically about markets, but there is still this emotional, psychological component that drives prices. And it, price movements are probably some balance of rational analysis and human emotion. What does that balance look like? I don't really know, but one thing that I have come to believe is I think the emotion is much more important than the rational analysis. I think markets move on emotions, hopes, and fears. That drives markets much stronger, much more strongly, I guess, than rational analysis. Market efficiency also seems to be an evolving process. That's an interesting point that might lead you to believe, and an important understanding is that particularly if you're a quant, some of the edges you uncover may not last for 10, 20, 30 years. So we will find things that work and then they may stop working, and we kind of need to stay ahead of that curve. So trust you will have these slides. You can read them and you can go through them yourselves. I don't need to read every point on the slide. Randomness. Now let's think a little bit about this, because this is something that I also argue. I wrote a book called The Art and Science of Technical Analysis, but I would argue that I am not really a technical trader, a technician. I think the vast majority of what passes for technical analysis and what people get certifications in, again, is garbage. And this discipline of technical analysis does not fully understand randomness. This is one of the strengths of quantitative analysis, is that quantitative statistical work does understand randomness. And some of you may have a very deep understanding of the topic. If you don't, let me share a few words. And if you do, let me put it in context. As humans, we have very poor intuition and perception of randomness. And it's very hard to look at something and say it is random, it isn't random. A very difficult thing to do is to sit down and try to generate by hand what would random coin flips look like. We're not good at that. And it's there are a lot of things that we do very well as humans, but understanding randomness is not one of those things. And we all suffer from this. It doesn't matter how educated you are. It doesn't matter how deeply you've gone into the mathematics, you still have this cognitive machinery that is good at seeing faces, good at recognizing voices, good at remembering names and places, not so good at understanding random patterns. We all struggle with this. And one of the things that really gets us is that there are more runs in random data than people would expect. So a lot of times we look at a trend in we look at a trend in a market and we say that there must be something going on there. But the reality is, if we just generate random data, we still see trends. So that happens in random data. Doesn't mean doesn't mean every trend is random, but also the traditional patterns of technical analysis occur in random data. And how do we overcome that? I'll share some ideas. Just the bottom line here is, if something is random, we can't make money with it. We have to have a non-random edge in the market. Otherwise, we're just kind of flipping that coin. We'll make money, we'll lose money over the long haul. And when I say we can't make money with it, be clear. I don't mean you can't have a winning trade, or you can't have periods of winning trades. But over the course of a trading career, which is what we all hope to have, right? You hope to be doing this and take substantial money out of the market year after year after year. And the only way you're going to do that is if you're able to have something that departs from randomness. Randomness is the great enemy. That's another way you might think about it. I'm going to skip the slide a little bit. I'm going to show you an example. Let me just play this out, and then we'll discuss it a little bit. But you probably all understand support and resistance. Traditionally, this is an area which may offer sufficient supply or demand to stop prices. And if you do use these levels, I think it's very important to think in terms of potential support and resistance. So in other words, don't draw a line on the chart and say this is a support level. As price comes down to it, don't say price is coming to my support level. Just attach the word potential. Price is coming down into my potential support area. And that seems like a silly thing, but language is powerful. And language can shape our thinking in a lot of ways. That's a small change that will open your mind to the possibilities and is a constant reminder to the wide range of possible outcomes. So add that word. Support and resistance, usually zones, not exact levels. When I work with traders, training traders, I would say the right tool to draw support and resistance is probably a crayon, or maybe it's one of those big pencils that young children use. It's not an architect's pen. It's not a fine point pen. It's a big, rough, messy area. A lot of ways to find these, and I've listed some of these here. A lot of people use support and resistance areas. I want to show you some levels that I calculated in 2010, and these were for Baidu based on the daily chart. What I would like to do, these levels were generated based on the daily chart, but I want to zoom in and look at how these act intraday. So we're looking at a little bit of multiple time frame influence here. And remember the points that I just made. Let me add one more. With calculated levels like this, one of the things that we're often taught is when a level breaks, price will move to the next level. And we hear that with Fibonacci levels, with floor trader pivots. When one level fails to hold, the market will likely go to the next level and stop. So let's look at these levels. Here these levels are on the daily chart. And this slide is a couple years old, but you can carry these levels forward if you wish. You can see them on the daily chart, but let's dig into intraday. And I just want to point out, let me see, I think I have a pointer here. Got it. Okay. So if you look at the arrows, you can just see where this level held as support. Price went up. Where did it stop? Predictably, the next level. We have a gap through the level, fails to hold above, multiple tests below, level is broken, and we are off to the races. Level holds as support. I've marked most of these with arrows. Notice what happens when the level breaks. Where does price stop? The next level. Now, those of you who have traded this stock know this is not a clean trading stock, so these are actually pretty clean tests, but they are not perfect to the tick tests. Here we trade around the level a little bit, level is broken. This green arrow at the right side of the chart shows a very common pattern, which is the support level is broken, and then the retest, it holds as resistance, and price sells off. I'm going to move quickly through these slides. Here is another example. The level fails to hold, retest holds almost to the tick. Where does price stop? The next level. Look at those nice clean tests. Same thing, gap through. Where does price stop? Next level, multiple tests. Here we have a break of the level, consolidation above. Market continues higher once the level is broken. This is picking up from that consolidation. Where does it stop? Next level. Look at this, 4 pretty clean tests. Level is broken, and one of the things we're told over and over is this idea of polarity, right? That resistance once broken becomes support, holds as support here, broken, consolidates. Where does it go? Next level, retest. Anyway, you get the idea. Now, people, and here it is on a one level chart. Here you can see much longer term significance of the levels, but here's the point, and this is the point where in the presentation where I've given this presentation live, face to face with people, and people sometimes get very angry. I've had people argue. I've had people, a lady threw a book one time. I generated these levels publicly, and here's a YouTube link you can click. These are random levels. So all of this action that I just showed you, the way I generated was I turned the price bars off so I could not see them, and then I drew random lines on the chart, and I did this live. I did this for only one stock. So I did not go through and pick, I didn't do 9 stocks, and I'm showing you the one that looks really good. This is the one I did 5 years ago and 6 years ago, and it has worked very well. And this will happen, the point here is that this will happen with any random line you draw on a chart, that it will look valid. It will look good. One of the things you hear when you ask people, well, how do you know such and such tool works? And they'll say, well, can't you just see it works? No, you can't. You can't. You can't trust your perception. And I'd encourage you to go back, look at this video. And thank you, Yana dropped the link in the chat. So check out the video later and take those levels forward and give them some consideration. It's an important point. So we can't trust our perception, and we need tools. This is why we need quantitative tools. And I started as my background, I was a musician before I was a trader. And I did not have a good quantitative tool set to look at data, to understand data, so I had to develop it. I had to get those skills. And I think that's kind of an important message, because you can too. No matter what your background, you can understand these tools, you can develop these skills. And I think it's important, because I think the days of people thinking they're going to see some simple chart pattern and trade off of that, I don't think you can build a sustainable career. I think it takes a deeper understanding of market action. And to do that, we have to be able to analyze market data. The goal of all of this analysis is to be able to distinguish non-random price action from the noise. To be able to look at something and to say, hey, that's different. There's something going on with this pattern. Or with and there's a lot. I stumble over the word, because there are a lot of things we can plug in to be the condition that we're looking at. We do need some way to say that this is probably not random. Significance testing is an important tool. There are some pitfalls to that tool, and it's something that you should be aware of. We also do need to consider economic significance. So there will be times that we go through and do tests. I'm going to show you how we do some of these tests, and we find something that appears to be very significant, but it's a very small movement. It's a very small price movement, and it's so small that even if it's real, we probably can't make money trading it, because we can't overcome our transaction costs. Our transaction costs, by the way, it's not just the commission you pay your broker. It's also that's a big one, but it's also the bid-ask spread. It's also the cost of financing. If you different markets have different costs associated, but we have to have something that also will overcome those costs. So here are the tools that I found valuable to look at market data. And one is just to really understand basic statistics, to be able to summarize a data set, to understand if you're looking at stock market returns, what's the average return? That's a good question. But then the next question is, well, what average should we be using? How much variability is there around that average? It's very different if we can make 6% a year with a high degree of reliability, or if we can make 6% a year, but on average, but some years are 30%, and some years we lose 20%. It's a very different ride and very different implications for how we might trade that in the market. Simple statistical tests are important and powerful. Linear regression, where we're looking at the relationship between two. And we're not going to dig into these tools. I'm going to turn here very soon, and we're going to look at some things applied more practically to markets. But these are just tools that we can use. It is also important to, when you find a pattern, to understand how stable it might be. Was it something that just worked the last 3 months? Was it something that worked the last 5 years? Was it something that worked 10 years ago and no longer works? There's a lot of that out there. There are a lot of people selling systems or methods that might have worked in, for instance, late 90s as markets were becoming electronic, but they don't work today. And we can have a discussion about, does that matter? There are plenty of people who make good money always innovating new systems, always finding new edges. My approach has been to kind of look for the things that don't change. And in the process of establishing my methodology, I went back. We have price data from 1800s on stocks. We have commodity prices from medieval Europe, 1400s. We even have some of those clay tablets that the Phoenicians wrote on. Those are price records. They recorded price changes in commodities like barley and dates. And I have analyzed those prices and see similar patterns to what I base my trading on in modern markets. So I'm reasonably certain that, I can say in full confidence, I've looked at the entire recorded history of financial markets, and rather than focusing on what might work today, I've looked for the things that I think are probably related to human behavior, and I'm pretty sure they'll work tomorrow too. General advice as you dig in to start to understand markets, I think it's very important. I'm not going to go through this entire slide, but I will tell you one thing. I'm a big believer in doing work by hand. We need the computer. We need the breadth of perspective to be able to analyze a pattern across hundreds of markets, to look at hundreds of thousands of price bars if we're looking at something intraday. We need to be able to do that. But you, as a trader and as an analyst, you also need to begin to develop some intuition and understanding of the data. And I think the only way that happens is if you spend some time really getting your hands dirty. And I talk about a lot of ways to do that, but some very simple ways are just follow a few markets and write down the prices every day. Get a piece of paper, get a book, get a pencil, and write down closing prices every day. Doing that over the course of many weeks or many months, you will begin to internalize some of the patterns. I also think it's a very good idea. Some people think it's a very old-fashioned suggestion, but it certainly made a difference in my perception to keep price charts by hand. And I did it intraday. There are a number of ways you can do it. Just decide what time period you want to do and draw bars or candles every hour on one or two markets. And eventually, I can't fully explain it. I don't know that anybody can, but it turns on a part of your brain and makes you focus on the data a little bit differently than if you were just looking at a chart. So I would encourage you to spend some time doing some work by hand. A lot of my testing is done, and let me also pause here just for a second as we get ready to dig in a little bit deeper. If you have questions, I certainly will stick around at the end of the presentation and answer those questions. I'll do my best to get every question. I have no real time constraint on the other side. You may want to ask those questions as we go along, so just drop them in the chat box, and I may get some, if I ignore it, I'll get it at the end, but I may get some as we go along. So if you have questions, please feel free to type them into the chat box. So an event study methodology. Here's the way this works. We define a test universe, and I find it useful to look at stocks separately from commodities, separately from currencies. And you have a question with commodities. How far should we separate these? Do you want to separate stocks by market cap or by sector? You want to separate your commodities into metals, energy, food. What about the financials, which are going to have some overlap with stocks? A lot of things you need to think about, but you do need to make sure that your test universe is big enough that you capture, that you capture different market regimes, that you capture periods of flat markets, uptrending, downtrending markets. And for most markets, 5 or 10 years, well, 10 years probably will give you a reasonably good sample. The next thing you want to do is to adjust for baseline drift. So what you're doing here is every market has let's say a buy and hold return. If you come to me and say, I have this great stock strategy that makes 7% a year, well, you pretty much make that buy and hold. So you have to overcome that as a hurdle rate. And all of the patterns we have one of the ways to separate them from randomness is to look at them against that baseline drift. They have to do better than buy and hold, in other words. Then you compute summary statistics for each asset class, and as I said, the baseline drift is particularly important. Then you need to define, and I have a question here, what types of patterns do I look at? Define a precise condition that will result in a trading signal. And I would suggest these probably should be symmetrical for buy and sell. You certainly can make them asymmetrical, but for my testing, I keep things very simple, very robust. And then you go through each bar of the universe looking for that specific condition. And the condition could be very complicated. It could be very simple. A simple example might be price closes higher today than it did yesterday. A more complicated condition, we run into some concerns with those, and we'll talk about some of those concerns. What you do once you have gone through each bar of the universe and identified the condition, you then look at returns following what happened after this condition occurred historically. And you can, you look at the next bar and the next bar, and you can decide what time window you want to look at. And then you see the next slide. You basically align all of those results. So you produce a synthetic return series. You have your event, and then what happens the next day, and the next day, and the next day on average. And then you compare that synthetic return series to the baseline, and that's how we're looking for an edge. I'll show you some examples of that. I've done a lot of testing, and almost all of this is available for free. A lot of it is on my blog. I also have a free trading course, and that's absolutely free. There's no upsell, there's no premium area. I'll tell you a little bit more about that. I've talked about the lessons from these tests, and the bottom line is that most of the tools of traditional technical analysis show any juice at all in statistical tests. Touches of moving averages, most patterns, Fibonacci ratios in particular, there is no quantitative evidence that Fibonacci ratios have any significance in the market, and I don't use them. And I only want to use things that have passed this quantitative filter, and then I will incorporate them into my discretionary methodology, which is what we're talking about here. But if we don't have some quantitative edge, then it's nothing more than a random coin flip. It doesn't add anything to our analysis. Some standard indicators do show an edge, but you have to know how to use them. You need to know what that edge looks like. You need to know how to apply it. One of the things we see with indicators is people apply them in ways like, for instance, RSI has an edge. RSI has a statistical edge for identifying overbought, oversold points. There are other ways to use it. For instance, putting trend lines on RSI, where you've taken a tool that has an edge and now you're using it in kind of, maybe a creative way, but it doesn't mean that it works. And I'm only interested if I have something that can show me a quantitative edge. That's kind of the first step to get in the door of my trading toolkit, is it has to have some kind of quantitative edge. That is, I think if I could go back and look at my earlier trading self and give myself one message, it would be that a lot of the patterns, a lot of the things we do are kind of based on what we wish worked, what we hope works, but you don't have to do that. You can actually dig in and do the testing. So, I also, like I said, a lot of that stuff I have out there. You can go check out my blog, and you can read in detail a lot of the tests that I've done. And I don't want to spend too much time here on what doesn't work. Rather, I want to talk about what works. And I want to talk about this model of two forces, the idea of momentum and mean reversion. Mean reversion is the tendency of a market to go in one direction and then to come back, to snap back. Momentum is the tendency of a market to go in one direction and then to continue. And to some extent, that's kind of the whole question of trading right there, isn't it? Imagine you have a market that makes, let's just say down. You have a market that makes a big move down. And the question is, well, do I buy that market? Is it going to snap back? Or do I short that market? Is it going to keep going down? It's kind of the core question. And the reality is that these forces are usually in balance. And when they're in balance, price is kind of caught between these two conflicting forces and price moves randomly. This is why most academic tests of price motion find that prices pretty much random walk most of the time. But what we're able to do is to identify some conditions which show when one of these forces is more likely to win. And that's pretty exciting. And mean reversion. Well, here are patterns, and these are very simple patterns that show that mean reversion is likely to win in the immediate future. Fading large single bars. And you have to define large, a lot of different ways to do that. Fading in-day runs, in other words, replace in with a number, 3 days, 5 days, 8 days, whatever number you want to use there. There are different kinds of edges in different markets. Fading breakouts of in-days highs and lows. And this is the, trend followers will enter on these channels. There's also an edge to fading, and we'll talk about that. I'll show you that in a moment. Fading large excursions from moving averages. Well, you have to define large excursion, and bands are useful here. Keltners or Bollingers when the market is stretched far from an intermediate term moving average. Even though I will tell you, if we go through and test moving averages, touches, crossings, different crossings of different moving averages, there's no statistical edge to those tools, but the concept of price being, so in other words, I would not get excited about price crossing a 50-day moving average, but I would be interested in knowing whether price is somewhere near an intermediate term average price or far from an average price. It's a different way to see and use an indicator, but the sad reality is we all want certainty. We all want precision. You would rather have me give you a precise forecast, even if it was wrong, than to say things are kind of messy here and we don't really know what's going on. One of the very important lessons here is that different asset classes have different tendencies. And this means one of the other things we're told, you can apply any tool to any market, any time frame. That's not really true. Well, it might be true because most of the tools people are talking about don't have an edge, but that's not really what they mean. You will see significant differences in different asset classes. And here's a good example. So the way you read this is fading plus and minus 3 sigma, 3 standard deviation closes. Again, I talk about how to define that on my blog. And if you buy, so this first section is the top is buys, the bottom is sells, and this first column is stocks, equities. And you will find if you buy large declines, the next day you're up 25 basis points, 0.25% on average. If you were to short sharp rallies, sharp single day rallies, you would have a negative return 2 days later of 0.33%, 33 basis points. And you see here, these are the days. I do 1, 2, 3, 4, 5, and then just hit the week. So we're looking at a month out here. A lot of different ways to structure the test. But this is an example of a statistical edge in stocks. There is an edge to fading big moves in stocks. There is not, however, and I'm not going to spend a lot of time on the slide, there's not, however, the same edge in futures nor in currencies. So here you see a very, very simple price tendency that shows a significantly different edge in stocks than in other assets. Here is a 20-day channel breakout. And trend followers, the turtles have made a lot of money trading these channels. So one way they're traded a lot of times is you go long when the upper channel is broken, you go short when the lower channel is broken. And here's a test using 100-day channels. And look what happens with, actually let's do futures first. So the middle column. If you were to buy upside breakouts, you would find a month later you're up 0.75% on average, and you're also up 57% of the time. If you were to short, you'd be down, again, these are basis points, so it's 1.15%, and you would be up only 46% of the time. So this is a strong trading edge for trend following in futures. If you glance over at the Forex column, you see something similar in Forex, perhaps the edge in this particular sample is not as strong, but I want to call your attention back to stocks. Look at the difference. Look at 20-day buys in stocks. You are down almost 1% versus up significantly in futures. And the shorts in stocks, you were up significantly a month later, and you're down with futures. So here you see this is a very simple test, just saying what would happen if we bought every time we broke out the top of a 100-day channel, shorted below. This did put 5 days between entries, so you don't keep piling in. You can take that condition out. It doesn't really make much difference, but we see there is a very significant difference in the way stocks act and the way futures act. What does this mean? Well, if you're a discretionary trader, it probably means you need some slightly different tools for those markets. Good example, stocks at 52-week highs. This is a common thing. A lot of people invest fundamentally, and they just kind of throw some technical conditions in. This is a common technical condition that gets thrown in, and the idea is if the stock is at a 52-week high, the market's already voted it's a good stock, you should buy it. The problem with that is that it puts you on the wrong side of a very strong tendency. Here's a statistical test showing if you were to short stocks that made 52-week highs, a month later you're down about 1%. Now what you would find if we extended the test out, that typically stocks pull back and continue higher, but the right message to give people is to short stocks that have made 52-week highs and have pulled back. I'm sorry, I misspoke. Let me clarify that. Is to buy stocks that have made 52-week highs and have pulled back, but not to buy stocks that are breaking to 52-week highs. That's, from a technical perspective, almost exactly the wrong thing to do. Here's I alluded to a standard RSI, very simple test, just overbought, oversold 70-30, other way around, and you see a strong positive edge in stocks for the buys, strong negative edge for sells. However, guess what? You don't see the same thing in futures or currencies. So you probably do not want to apply this tool the same way to your stocks as you do to your currencies. And this is one reason why people struggle. They're simply using tools in the wrong way. Momentum. So we're talking about mean reversion. Momentum is the opposite, the tendency for market to make a big move and continue. And two conditions that set that up very well: volatility compression. That's what we had in the stock indexes today. We had a significant sell-off because we were alerted to that possibility because the volatility was very compressed. And I'm going to skip over some slides a little bit just to show you this is a test. What I showed you before, where we're fading large single-day moves, if we add the condition of volatility compression, then meaning that the market has been quiet before those large moves, then all of a sudden the test changes, and we start to see an edge for continuation over some time frames, and we do see similar edges. Most of the momentum tools, by the way, work more similarly in futures and currencies to stocks than the mean reversion tools, which tend to work quite differently. So that condition of volatility compression is one, and a pullback. Again, I'm going to skip over some things, but here you see a very simple pullback test, and this was structured so once price pokes outside of the Keltner channel, we're looking to short around the moving average, and you do have to set this up for a test with precise conditions. Here's the results of that test, and you can see pretty strong positive results in stocks, positive results in futures for the buys and in Forex, and the shorts, negative results. That's what we want. We want shorts to go down, right? Negative results in in stocks, in futures, and in currencies. And this is one of the few patterns that does seem to have a similar edge in all asset classes. And by the way, I base a lot of my trading on pullbacks. I find it to be a very, very useful tool. So I would encourage you, and I know that many of you listening are at different points in your trading journey, but if you are very focused on indicators, if you're very focused on specific patterns, I would encourage you to step back and to see market movements in the context of these two forces, that we have mean reversion and momentum that usually balance each other out. And our task as traders, our task as analysts, is to look for conditions that can show us that one force is more likely to win in the future, that we have, and then we have some reason to expect the market to be non-random. And I realize this seems to be a little bit dry, but if we can identify those points where the market's is perhaps a little bit less random, might be the best way to say it, then we have the chance to make money. We have opportunity for profitable trading around, potentially profitable trading around those areas. And I would also encourage you, my goal with all of my work is not just to give you some authoritative pattern, because I don't know that that really exists, but to give you the tools that you can do the test yourself and that you can develop these skills. You can begin to look at and understand markets yourself. I would encourage you to think about simple patterns rather than diving straight into complexity, which is what a lot of people want to do. But there are strong edges to be found in some very simple patterns. So, once you know that, then I think one of the problems is, what do you do with it? How do you apply it in the form of a system? And this is where human behavior becomes important. Remember, I told you half an hour or so ago that we have very poor perception of randomness. And that randomness applies not just to the market, but also to our trading results. Imagine a system here that wins half the time, loses half the time, so there's no break evens. And when you win, you will always win 1.2 R. So that's 1.2 times the amount you're risking. When you lose, you will always lose only the amount you're risking. You will never have larger than expected losses. You'll never have larger than expected wins. This is a very predictable, very tame system that does have a positive edge. And if you walk through the math here, I'm going to walk you through the details, but if we were to do 250 trades, we would expect, risking $2,000 per trade, we would expect that we should end up with $50,000 in profit. Now think about that for a moment. $50,000, I almost said give or take, because we know there's going to be some randomness, right? There's a chance you're going to have a lot more winners, a lot more losers. But what does that look like? Well, look at this next slide. This shows the result of 50 traders trading 250 trades of that system. So the only thing that is different, they all traded the same system. Every time they won 1.2 R. Every time they lost 1 R. Each trade was a 50% chance of winning or losing. The only thing that is different is random chance. Some of them had more winners, some of them had more losers. Nobody made mistakes. But look, this is where we would expect to end. Starting with $100,000, we would expect to end with $150,000. Did you realize the results could be this variable? That with this very simple, predictable system, you had somebody who made twice as much as we would have expected him to make. You also, interestingly enough, had a trader who lost money. Is it possible to lose money trading it? Like some people say, all you have to do is have a positive expectancy system and trade it. Well, here is a simple test. Somebody was trading a positive expectancy system. This person made no mistakes. None of these traders made mistakes, but he still lost money. Not only that, he was underwater pretty much the whole time. Also worth mentioning that there were a lot of traders, even some who managed to carve out small profits at the end, who were in the red for many trades. You're also told things like, you need 30 trades to really see how the system works. Well, not true. Here's 250, and you still can't see. Even with that, the results are much more random than people would expect. So you have to plan for this. And when you're developing your trading strategy, when you're developing your trading methodology, here are two mistakes that I think people make. And I think the reason that it's difficult to understand these is because both of these are a little bit right. One of them is the quest for the Holy Grail. So you're always looking for the better indicator, system, or tool. These people will run from guru to guru, chat room to chat room, service to service. They may have so many indicators on their chart that the indicators often contradict. They don't know what to do. And it's very easy in this case to blame losses on imperfect tools. Oh, I just have to dial in my stochastic. Might be something you hear. Or, oh, that guru lost his touch, so I'm going to go to this other chat room. The other approach is psychology. Tell me about your mother right here. And the idea is that all of your answers are to be found in trading psychology. These people say anything works. There's a lot of ways to make money in the market. I would argue the opposite, actually. I think it's very, very hard to find an edge in the market. But people who believe that psychology is the answer, anything works. You just have to find what works for you. And if it doesn't work for you, then you got to get your psychology right. The problem is that both of these have some truth. You have to have a solid foundation that incorporates good trading psychology. You have to be able to do the right thing, but you also have to know what the right thing is. Both of these answers are right. They're also both wrong, and they're both wrong without the other. I certainly could tell you exactly the right thing to do in markets. And if I've seen this in many traders, if you don't have the right understanding of risk, the right psychological approach, you can't do it. You can't apply it. You also can work until the sun goes nova on your psychology, but if you're using a trading methodology that doesn't have an edge, you're not going to make money. Psychology is not the answer. You have to have both of these, and you have to have tools that work. You have to have the right psychology to apply them with discipline. And I could talk for hours about discipline. That's an entirely separate topic. Discipline just means being able to do the right thing, but it's really hard to do. Easy to say, hard to do. So I do want to touch on two styles of trading. And this is something that if you're finding yourself as a trader, you might not realize the importance of this, that there are both with trend and counter trend approaches, and they're significantly different. And they require different psychologies. They require different approaches to trade management. Generally, and the problem is that we have a lot of these sayings out there. Ride your winners, cut your losers. That's true with trend following. If you're trading a counter trend system, then you need to be very quick in taking profits. So it's not true with counter trends. So we have all these sayings that apply to one style of trading, and they're all true, but they're kind of dropped out there like they're true for everybody all the time. And that's not the case. It's not the case at all. So, I trust you can read through this slide. You'll have these slides. You can look at it. You have to decide which one of these is right for you. And I think in many cases that it's valuable and important to have both. When I was learning to trade, I was doing intraday trend trading, and I would find myself, because my only tool was trend following, when the market wasn't trending, I would still try to force trades. I didn't have the lens to understand mean reverting markets. I didn't have the tools to understand non-trending markets, and I do think you need both. I think it's very difficult to trade from only one approach unless you're purely systematic. Do want to touch here a little bit. Let me flip through these slides because I want to leave some time for questions. I touched on the pullback, and I think this is, if you are wondering, I've kind of challenged your thinking, and I hope I have in some ways. And if you're wondering, well, where do I go? I think trading pullbacks, and this must be one of the oldest trading methodologies. It's also one of the best and one of the most powerful. And if you can train yourself to find and to see these pullbacks, I've also run a number of quantitative tests to verify the edge. I showed you one of those earlier. This is a good tool to build your trend following approach, your with trend approach. A lot of ways to enter these patterns, a lot of subtleties, a lot of, here's on this slide, if you're looking to enter this market that is pulled back, one of the ways is to look to enter against the lows. You also can do some type of breakout entry as the market heads to new highs. Both work. You just need to be consistent, and it needs to be part of your trading plan and trading rules. You basically don't want to be making the rules up for every trade. Where you put the stop matters, whether you favor closer stops, further stops. Everything is a trade-off. You need to think about profit targets. One of the good ways to structure pullback tests is to simply look, if you imagine you were buying pullbacks here, and note how many times the pullbacks hit the previous trend extreme. So we're not necessarily playing for this condition where the market pulls back and keeps trending. This is also a winning pullback trade. So you have a condition here where the market pulls back and then pokes to new highs, and that you may have a profit target there. It's one thing to think about. So a lot of ways you can do with this, but a lot of ways you can deal with this and things you can do with it. The point of this is that this is really only the very beginning. It is your task to figure out how do you extend this? How do you make this your own? How do you write rules around these patterns? How are you going to find patterns? How are you going to understand the edge? How do you monitor your performance? How do you size positions? In short, how do you develop the skills of successful trading? Because trading really isn't about what you know. It's not about knowledge. I could, in a half-hour targeted conversation, I could tell you a lot of what you need to know to trade successfully. And in fact, I just have. But applying that takes a significant amount of time. And to learn to do that, the learning curve for traders is probably 3 to 5 years. There are a lot of things out there that would like you to believe in the get-rich-quick approach to trading. But it doesn't work like that. If you're going to develop these skills, it takes a lot of time. I'm absolutely convinced from the many, many, many traders I've seen do this over the years, you are looking at a learning curve of 3 to 5 years. And I do want to tell you a little bit about my firm. I would like to share some of my research product with you. I'd like to invite you to make a trial of that product, and let me walk you through that and talk about how it might help you develop your own process. So our approach, I'm the CIO, Chief Investment Officer of Waverly Advisors. Our approach is a blended quantitative discretionary perspective on tactical trading. And we look at broad context. We look at everything from global stock markets, drilling down to individual stocks. We also cover currencies, futures. We do work with options. We work with purely quantitative systems and also systems that have an element of discretion, and I'll show you that in the research. We publish extensive reports on the weekends, many, many pages of pretty in-depth analysis of all of these markets, and a very short daily update that is designed just in a few minutes to let you know really what's happening in the markets. And I'll show you some of the pages from the Tactical Playbook, talk you through a few of the points here. We do begin with bullet points and performance review, and you can see our biases, my biases on the major markets we follow, trend, volatility conditions. This information is a few months old, so this is not absolutely current. If you only have 3 minutes to read the research, this is where everything you need to know from a very high level perspective is on the front page. I next include an article that many times is educational. And our clients, we created a product for institutional money managers. And one of the great joys that I've had over the past few years is to see that this is a product that also works and resonates with developing traders, with retail traders. And I'm very, very happy to have a number of developing traders as clients. And so we have a short article here. Sometimes we'll address current market conditions. Sometimes we'll address more conceptual things, some aspect of trading psychology or of building, developing a trading system, managing risk. Then we have, this is an example of one of the many pages of analysis. I try to keep everything very concise, bullet points, and a few points, most important points illustrated on charts. We also cover, and by the way, we cover the complete range of time frames. Raleigh mentioned that at the beginning, that I have been a very short-term day trader. I've been a scalper. I've also constructed portfolios for multi-year horizons. I think the bulk of my focus tends to be on kind of the 2-day to 2-week time frame. So many people call that a swing trading time frame. We do have a number of clients who are day traders, and we focus heavily on setups, conditions, and specific trading opportunities in stock index futures. We cover, here's a rates and currency page, commodities. This is an example of how we publish discretionary trades. and these are discretionary trades that we have on. We give precise entry points, stop levels, targets, and over the period of time that we've been publishing for 6 years, we've made money, significant money every year for our clients, and very, very pleased with the performance of these trades. However, having said that, I would encourage you, and I think the clients who get the best use out of our work, they don't just take these as trade recommendations. These are learning tools. These are, we talk about these trades as they set up, as we manage them, what we see happening in the market. And these are good departure points for your own work and your own development as a trader. And I think that's very important. We also publish a channel system, that a trend following system. If you want to run your own CTA, this is a trend following system that has a strong edge and it's performed very well. This comes out in the report every day, precise entry exit levels. And then we do include also a number of things. Relative strength is an important concept. We have not talked about this much in this presentation, but we include a number of quantitative tools that you then can use for your own work, whether you're day trading, swing trading, building portfolios of stocks. We have a lot of tools that will show you specific setups and also will show you where the big flows are in terms of sectors and industries and countries, so you know where to concentrate portfolios. And it's a product I'm very proud of. It's something that I work very, very hard to develop, and I have a great team that works with me, and would really love it to if you'd like to take a look at the research. So we have a special offer here for those of you, and by the way, if you have questions, this is a good time. As I talk a little bit more about the research, you may want to type your questions in the box. I will get to all of these questions. I do want to point your, thank you, I just have the link popped up in the chat box. Absolutely free, no obligation trial. We don't do any kind of hard sell. If you do purchase through the special offer, we'll offer 10% off the annual rate. I've used the word client. I don't think that I sell a newsletter or I sell a service. And this comes from our background as an institutional firm, I think, but we think of our clients, our customers, if you will, as clients, and one of the things that we do is we talk to them. So as part of the trial, you and I will actually have a chance to speak on the phone. We'll spend some time on the phone and talk about the research, also talk about your trading, your approach. You can ask me anything. I may not have the answer, but hopefully that conversation is important for some people. And that's something we also do. I speak with most of my clients several times a year, so that's part of the whole thing. I want to point you to a couple more resources. So I would also encourage you to check out my blog, follow me on Twitter at Adam H. Grimes. I do a podcast that covers a number of topics, both in the specifically centered on markets and trading, but I've also done quite a bit on learning theory and performance development. I have a number of other interests. There's even a podcast episode on coffee. So there's some and not trading coffee, how to make coffee, how to roast your own coffee. So there's kind of a wide range of things there. But check out my blog. I also do have a free trading course, and this course has 30. I actually don't know. Some probably approaching 40 hours of video. It's not just me. There is a quantitative module there Ernie Chan did. There's also a number of modules on options that Jeff Button has done, and I'm bringing on some other people to contribute course modules. This is completely free. You don't have to take the Waverly trial. There's no premium area. This is simply something that I put out as a gift to the trading community, and I would encourage you to go check it out. Easiest way to find it is you can find it from my blog. So I'll leave and here's my contact information. You can drop me an email, adamhgrimes@gmail.com. You can also contact me through the blog. And like I said, follow me on Twitter at adamhgrimes. And here is the link to the Waverly Advisor site. So I will go ahead and go through some of these questions here. If you have questions, This is, I'll stick around until I get all of the questions. So the question, do you consider the patterns and randomness change with economic and demographic conditions? Um, yes, I mean, markets evolve, markets change. What is much more interesting to me is what does not change. If I have a pattern that changes, that's actually kind of an interesting question. If I have a pattern that changes, then it's almost a different pattern. And there there could be ways to structure that, but in general, what I have found, where I have found the robust edges are in the relatively simple patterns. And I've showed you some examples of those, and there's a lot more information I put out there in my blog and in my book. Um, yeah, the markets change and evolve, but it's also, I would be careful about overthinking, I guess. And a question like that, when you start to dig into economic and demographical conditions, and you want to look at different parts of the business cycle, you risk adding too many moving parts to the test, and then it's too easy to fit the question to the data, and the test can be deceptively good, basically. Um, do I not agree with intermarket analysis? Well, I did not. I don't know where that came from. I did not address intermarket analysis at all here. It certainly is a tool. A lot of different ways to do that. The point of this presentation was just on relatively simple directional tests in one market, but there are a lot of different things we can do. And I hinted at. I think that question came in the middle. I mentioned relative strength at the end, which is a good intermarket tool. There are a number of things you can do with spreads and spread trading. So certainly there is power there, and there are things to do there. A couple questions on downloading the slides. The presentation is being recorded. There will be a link. I assume the link will be emailed to you, so you can watch it again. If you want the slides, email me, and I will send you a PDF of the slides. I'm certainly happy to do that. Ray asked, I work 5. Basically, the question is, here's somebody who works all day and is wondering how he can learn to trade. Will the research work? Well, we do have a number of clients who look at the markets once a day, and I think if you're a swing trader, it's probably counterproductive to do too much intraday. And I went through a significant part of my trading career where I was making decisions outside of market hours and then was kind of on autopilot while the market was open. That certainly works, but I think where I would caution you, where you might run into trouble, is if you try to do a trading approach that doesn't fit with the realities of your life. So in other words, if you do work 5 to 5, as this guy does, and you're trying to trade hourly bars, that might be a little bit difficult. There is a way to participate in the market that will work for you with your lifestyle, but it really, you need to spend time making sure it works. And a lot of the work in the Waverly Advisors research is based on those 2 days to 2 week swings, which really can be traded with very minimal time. And that's something, like I said, I've been a day trader. I went through many years of my life glued to the market every tick from pre-market to close. And it's not really how I decided I wanted to live my life. And so if that's a different presentation, but you might think about why you're trying to day trade if you're trying to do that. Is this applicable to Forex? Yes, my research covers Forex specifically. We've had a number of fantastic Forex trades. The way that we look at the market is different than how we look at stocks. It is a market that is very dominated by the US dollar, and that brings up some risks of correlated positions. So those are certainly issues we talk about, and we have a number of clients who focus on currency. So yes, absolutely. Having an edge in trading is okay, but a lot of analysis paralysis. Yes, that's what I said. There's also the behavioral side, that it's not enough to just know the right thing to do. If you look at my charts, and I showed you some quickly in the research, but you also can see many more on my blog. I have 2 indicators on my charts, and one of those indicators I don't really use. I probably should actually take off. So I think where people start to get paralyzed with analysis is when they have too many tools or when they're simply afraid of trading, and that's a separate thing. I think until this charge, the emotional charge of trading is gone, then it is it's very difficult to trade when you have this emotional charge. And that is something, go to my blog, check out my podcast. I did a podcast recently on developing mental strength, ways to do that, ways to overcome some of the emotions of trading. The trading course has tools that specifically address the psychological side. So I guess, I took your question and twisted it a little bit differently. If you're suffering from psychological issues that make it difficult for you to perform, then there are a number of ways to deal with that. If you're actually suffering from paralysis by analysis, then I would say you need to simplify your analysis. And I think that's my last question. So I guess the last thought I would leave you with here is that the things that I have found that work in the market, the robust things, are relatively simple. And though the analysis, the details of your trading plan might be quite complex, at its core, you should be able to explain it to an 8-year-old child. Or you should be able to write it on a bar napkin. It's another way to say it. And if you can't do that, if it's more complicated, then I would be a little bit hesitant to, I would be concerned about how stable that edge is going to be, I guess. So that's all I have for today, and I certainly appreciate your time and attention. Do check out Waverly Advisors, and it's a totally free trial. If you decide the research is not for you, it's absolutely fine. If I'd also encourage you to go check out my blog, sign up for my mailing list there, and I'll look forward to keeping in touch with you in many ways. So Raleigh, do I hand back to you here?